The purpose of this video is to review what Tony Dwyer had to say regarding the price of the S&P 500 and the yield of the 2-year US Treasury. This is Tony Dwyer. Tony Dwyer is Canaccord Genuity's Chief Market Strategist. This video was posted March 28, 2023. This is what Tony Dwyer had to say.
Your explanation for why you say you expect the S&P to test its October lows by midsummer, and could it go beyond that?
Well, it'd be historically unique not to from two fronts, Tyler. So the first one is the S&P 500 since 1957, when it became a 500 stock index, has never made the low. When it's down 19% in a cycle, when it's ever been down 19%, it's never made the low, the absolute low of that bear market prior to a peak in the 2-year yield. So that just happened, believe it or not, it was literally 2.5 weeks ago. So that would mean it would be the first time that if October is the low that would happen, number one. And number two, if we do go into a recession, again, all the data points in that direction. Now people are kind of jumping on board with that. If you do go into a recession, the S&P 500, again, in the same time frame since 1957, has never made the low before you even enter the recession. So it typically happens about 23 weeks in.
So Tony Dwyer stated two things. Statement number one, since the inception of the S&P 500 in 1957, for every sell-off of at least 19%, the S&P 500 has never made the low prior to the peak of the 2-year US Treasury yield. And statement two, since the inception of the S&P 500 in 1957, the S&P 500 has never made the low prior to the beginning of the recession. This video will focus on statement one. This is a chart of the most recent sell-off of the S&P 500. All the charts I'll be reviewing are of the S&P 500, which is in blue, and then the US 2-year Treasury yield, which is in red. The left is the price of the S&P 500, and the right is the 2-year Treasury yield. This data is updated to June 8th, 2023, last Thursday. It's currently Thursday, June 15th, 2023. So this most recent sell-off started on January 4th, 2022, and the trough, most recent trough, was October 13th, 2022. So this is January 4th, and October 13th is the trough. And you'll notice the 2-year Treasury yield was going up into this, and it had peaked in, I believe this is March. So what Tony Dwyer is saying is that the market has never made this low prior to the 2-year yield peaking. And because the 2-year yield peaked in March, it indicates that the market should roll over and take out this low. The following is a table of all 19+% sell-offs the S&P 500 has had since 1957. It includes this sell-off from 56 into 57, and the most recent one starting in January 2022 till October 2022. The left-hand column is the sequence of the sell-off. This is the beginning or the peak date of the sell-off. This is the peak price. This is the trough or end date of the sell-off. This is the trough price or ending price of the sell-off. This is the duration of the sell-off from peak to trough in days. This is the difference from the trough minus the peak in absolute values. This is the trough to the peak in relative or percent values. Two things to note. Note number one is that the US 2-year US Treasury yield data is from the Federal Reserve Economic Database, or FRED. Data from the FRED for the 2-year Treasury yield is limited to 1976, which is shown here. And you can see it only goes back to 76. And so the S&P sell-offs, only S&P sell-offs after 1976 will be analyzed. And that's what this column here is for. So you'll see this is 74, which was before 76. And so from 1980 will be the first sell-off analyzed in this video. And the second point is that sell-offs of at least 19% are from an all-time high. So if there's a sell-off of at least 19% before the S&P 500 made a new high, it is considered a continuation of the sell-off from the new high. So for as an example, in 2011, there was a sell-off of over 19% from here to here. However, this is the sell-off, however, because it didn't make a new high, which was the 07 or financial crisis high made here. This sell-off here is kind of considered a continuation of the financial crisis, economic cycle. This is a chart of the S&P 500 and the 2-year US Treasury yield. This goes back from 1976 until June 8th, 2023. And just to reiterate, the price of the S&P 500 is in blue. The 2-year US Treasury yield is in red. The price of the S&P 500 is on the left-hand side, and the yield of the 2-year US Treasury is on the right. To be determined, verify that Tony Dwyer's statement regarding the S&P 500 and the 2-year US Treasury yield is true. Determine if there was a S&P 500 sell-off that is comparable to the current one. And finally, draw conclusions from the findings. So this is the table of sell-offs from 1956 and 57 on to current. I'll be reviewing the sell-offs from 1980 to current. There's a total of 9, including the current one, which is this one. And in the current situation we're in here, the market made a peak January 4th, 2022. It then bottomed in October 13th, 2022, and the 2-year yield peaked around March 5th, 2023. So we have a situation where the market bottomed prior to the 2-year yield peaking, or its most recent peak, and Tony Dwyer said this has never happened. So going on to the other sell-offs, this is the 1980 sell-off. The peak was on November 26, 1980. The bottom was on August 9th, 1982. And here's the peak yield around August 24th, 1981. So clearly before the market bottom. So that's valid. 1987, the market peaked August 25th, 1987, made a bottom October 20th, 1987. And the yields were going higher. But I believe Tony would argue that the 2-year yield peaked about a week or two in October 14th, 1987, and this would be the peak of the 2-year, so in which case this would be valid. This is the 1990 sell-off. The market peaked July 16th, 1990, bottom October 11th, 1990, and the 2-year yield peaked, looks like, before the market did, which means it obviously peaked before the market bottomed. This is the 98 sell-off from July 20th, 1998 to October 8th, 1998, and the 2-year yield peaked well before the market did. So the 2-year yield peaked before the market bottomed. So this one's valid. This is a 2000 dot-com bubble. Market peaked March 24th, 2000. And bottomed October 10th, 2002, and the 2-year yield peaked, looks like, somewhere back here in May 2000. So this one's valid. Then the financial crisis, the market peaked October 11th, 2007. The market bottomed March 6th, 2009. And you could say, if this is the 2-year yield peak, this is June 16th, 2008. You could even say it was back before the market even rolled over, but either way, this observation is valid also. This is the 2018 sell-off, started September 21st, 2018, market bottom December 26th, 2018, and the 2-year yield peaked in November 8th, or around there, 2018. So this observation is valid. The COVID sell-off started around February 19th, 2020, ended March 23rd, 2020, and yields were already headed down. So you could say the peak was either back here in I guess this would be in September 2019, or even right before the market peaked. So this 2020 is valid. So of all 8 of these sell-offs, 1 through 8, they all appear to be valid. 1987 is the only one where I guess you could argue that yields didn't peak till here, but then I think Tony would say, well, they were past this sell-off, and therefore this is the 2-year yield peaking, the peak of the 2-year yield that he would be talking about. As far as a comparable sell-off to this current sell-off, in order for it to be comparable, you would need, like, the market here sold off 27.5%. So you would need something where the market in previous sell-off sold off, say, 20-some%, and then the 2-year yield peaked, and the market rallied, and then went on to make a new low, and then went higher. If the market goes higher and makes a new high from here, then it will be the first observation of these 9 I'm looking at where this has happened. So it wouldn't be comparable to any of the other 8. So the market would have to roll over. Has there ever been an instance where the market sold off, say, 20%, then the 2-year yield peaked, and then the market rolled over? And especially over the course of this has been 18 months since this peak until current. So I would say no. The only thing somewhat comparable to this sell-off is the 1980 sell-off, and you could say, like, the sell-off from the peak to, say, here, which still isn't, I don't even know if that's even 20%, and then the market kind of rallied here and then rolled over. So it rallied from here to here in the same way the market has rallied from the October lows to here. But the difference, again, is that even if the market had in 1980 had moved on to make a new high, the 2-year yield had peaked before the market bottomed. So I would say no, there has not been a comparable, at least of the previous 8 observations. There's not one that is comparable to the current sell-off. It has been verified that Tony Dwyer's statement is true regarding the price of the S&P 500 and the yield of the 2-year US Treasury, at least for these 8 observations, and there's no sell-off of these 8 that's comparable to the current sell-off. In order to draw conclusions from the findings, I'm going to start by playing this video from CNBC. It involves an exchange between Carter Worth with Worth Charting and Sarah Eisen posted April 14th, 2023. This is Carter Worth, and this is Sarah Eisen, and this is what they had to say.
Succumb.
I just want to throw one bullish technical stat at you. It comes from Tom Lee, of course, who's very bullish, of course.
Of course.
But so he says the S&P has now spent more than 25 weeks above the 200-day moving average. Since 1950, there are 0 instances of the S&P doing that, making a new low when it has spent that much time above the 200-day
There are a lot of these things. I would call it data mining, right? So if you find those, they're typically 20, 40 instances. If we talk to a statistician, typically need about 140 inputs for it to be statistically significant. It's like stock traders almanac stuff. Doesn't mean it might not work, but
you can always
find that. You know, you can massage the data to get anything you want. But
one quick note: Sarah Eisen misspoke. It's actually 200-week moving average, not 200-day moving average. Okay, so in that clip, Carter Worth suggested that at least 140 observations are required in order for a study to be statistically significant. As I showed, from 1980 to 2023, there were 9 times where the S&P sold off 19% or more, which is once every 4.8 years. And if you go back to 1957, there have been 15 times, which is 4.4 years. S&P 500 price data has been extrapolated back to the 1900s, which is roughly 120 years. And if you try to go back prior to that, it's difficult to get accurate, reliable S&P 500 price data. So say 120 years, and if these economic cycles transpire over 4 to 5 year periods, then that would result in 24 to 30 observations. And if you're going to argue that 140 observations are required, then you don't have enough observations to have a valid empirical study. However, once the intuition behind the relationship between the S&P 500 price and the 2-year US Treasury yield is understood, then the causation could be said to be valid despite lack of observations. The intuition is as follows. The 2-year US Treasury yield represents the short end of the yield curve, which the Federal Reserve controls. The Federal Reserve has a dual mandate of low inflation and low unemployment. We currently have elevated inflation. The Federal Reserve raises rates to combat this inflation, which increases the 2-year yield, and that's why the 2-year yield peaked in early March 2023. As the 2-year yield increases, the short-term yields become greater than the long-term yields, such as the 10-year yield, creating a yield curve inversion. Lending institutions that borrow on the short end and lend on the long end of the yield curve have difficulty making money with the inverted yield curve. Therefore, lending, access to capital, and money supply decreases. This decrease in access to capital results in economic contraction and a recession. As a result, the earnings estimates are lowered and the multiple on those earnings contract, resulting in a sell-off of the S&P 500 price. Therefore, because there is intuition behind the empiricism of the relationship between the S&P 500 price and the 2-year US Treasury yield, the conclusions can be argued to be valid and have causation despite a lack of observations. And finally, as far as predictions are concerned, first, the macroeconomic backdrop. The price of the S&P 500 made an all-time high of 48.1862 on January 4th, 2022, and made a low of 34.9158 on October 13th, 2022, and closed at 44.2584 on June 15th, 2023. The S&P 500 is estimated to earn $220 a share, which indicates about a 20 times earnings. The S&P 500 PD of 20 is considered fair valuation under normal macroeconomic conditions, but we currently have a yield curve inversion and inflation, so we are not under normal macroeconomic conditions. The price of the S&P 500 has been moving higher. The yield curve is inverted. There's around 4% inflation, which the Federal Reserve wants to bring down to 2 to 3% by raising rates. And the Federal Reserve held rates in June, but suggested 2 more rate hikes coming up, which indicates the 2-year yield could go on to make a new higher peak. All right, so the price of the S&P 500 could continue to melt higher and go on to actually make a new high. And this would be the first time the S&P 500 sold off 19% or more and made the low prior to the 2-year US Treasury yield peaking. However, even if this happens, I expect that there will be a sell-off due to the inverted yield curve, the effects of which have not impacted the economy yet. When the sell-off happens, I cannot make a prediction as to whether or not the S&P 500 price will drop below the October low, but I do expect the sell-off to bring the price lower than the current price of 44.2584, and therefore fixed income paying over 5% on short durations is appealing.